Today, is the interest rate rise balloon going up? The DFA Daily is the 28th of October 2021. Hello again, it's Martin North from Digital Finance Analytics, World Notice Post, covering finance and property news with a distinctively Australian flavour. In today's show, we look at the implications of the stronger CPI number for the RBA cash rate, what banks are doing to prepare for higher rates, and what Canada already has in play. Plus, some data on regional migration which confirms our own surveys. But first, picture this. A balloon full of air, pushed underwater, wants to rise. And the deeper you push, the greater the release pressure. I think that is a fair representation of where we stand on interest rates now, with the RBA artificially trying to keep rates low via yield curve control, as they have been buying bonds big in recent days, but upward pressures from the latest CPI read and from central bank moves in other countries is all making the job of interest rate repression harder and the risk of a sudden release more likely. The Reserve Bank of Australia's preferred measure of underlying inflation, the trimmed mean, which excludes extreme price rises and falls, rose by 0.7% in the quarter to be at 2.1% higher over the year. That's up from 1.6% in the June quarter. That's placed annual underlying inflation within the RBA's target range of 2 to 3%, which the central bank aimed to hit before raising the cash rate from its current historic low of 0.1%. The RBA recently indicated that it would not shift the target range despite acknowledging the effect of the cash rate on property prices, but it has not expected inflation to remain sustainably within the 2 to 3% bracket until 2024. AMP Chief Economist Shane Oliver and Senior Economist Diana Musia have, however, tipped that a rate rise may be on the cards for November next year, noting the September quarter inflation data was stronger than the Reserve Bank forecast in August. The RBA won't rush into a rate hike because it wants to see that inflation is sustainably within the target range, and for this to occur, it will want to see more evidence that the inflation pick-up is moving beyond transitory distortions due to the pandemic, Dr. Oliver wrote in a note. And it will want to see a tighter labour market with full employment and wages growth around 3% or more before hiking rates. However, with the economy now recovering again, we believe that the conditions for the start of rate hikes will now be in place by late 2022. So we are now penciling in a small increase of the cash rate from 0.1% to 0.25% in November next year, and a 0.25% hike in December 2022, taking the cash rate to 0.5% by the end of next year. While an increased cash rate will translate into higher consumer and housing interest rates, the overall rate level will still be low and far from tight monetary conditions, the two economists stated. The analysis from the AMP Capital Economist noted that most of the factors are likely to be temporary and are expected to fade as economies reopen and consumer spending rebounds from goods to services, relieving pressure from goods inflation. But the markets are also signalling a potential rate hike sooner than 2024. The latest ASX 30-day interbank cash rate futures implied yield curve moved higher after the ABS data came out yesterday, with at least 2 25 basis point moves now in next year and more after that. Once again, it confirms the pressure is rising to lift rates. And as Yahoo reported, Australia's third largest bank, NAB, has made sweeping changes to its home loan rates, the majority of which are hikes. This move means all four banks have increased the number of fixed rates within the last 2 weeks. However, NAB also cut its base variable and one-year fixed rates, bringing them in line with Australia's largest bank, CBA. NAB has cut its lowest variable rate by 0.4% to 2.29% for owner-occupiers paying principal interest. NAB is the last of the big four banks to reset its mortgage rates within 2 weeks, Rate City Research Director Sally Tyndall said. NAB's rate changes are uncannily similar to CBA's, with the bank hiking the majority of its fixed rates, but sharpening its base rate variable and one-year rate. And Tyndall said that with COVID-19 restrictions easing and vaccination rates steadily rising, the banks believed the economy would rebound quickly and were factoring in the increased cost of funding. While fixed rates are on the rise, the banks are moving in unison because the last thing they want to do is to lose business to a rival, she said. the big four banks have strategically made their one-year fixed rates starting with a 1, which might help with marketing, but it won't give customers looking for protection against rising rates much certainty. And NAB also slashed its base variable rate for owner-occupiers down to a competitive 2.29% to keep up with CBA and Westpac, who had both previously sharpened their rates. ANZ's base variable rate is now sticking out like a sore thumb at an inflated 2.72%. While banks are largely hiking fixed rates, there is still plenty of competition across the markets, with 145 fixed rates under 2%, but those are not likely to hang around in 2022, Tyndall said. But the point is this: banks are getting people into variable rates or higher rates over long-term fixed rates as a hedge against the rising rates. It's pure and simple. And it's worth looking at how this may play out ahead by looking at Canada. The Bank of Canada ended its bond buying stimulus program and accelerated the potential timing of future interest rate increases amid worries that supply chain disruptions are driving up inflation. In a statement yesterday, policymakers led by Governor Tiff Macklem announced that they would stop growing holdings of Canadian government bonds, ending a quantitative easing program that has poured hundreds of billions into the financial system since the start of COVID-19. They also signalled that they would be ready to hike borrowing costs as early as April as supply constraints limit the economy's ability to grow without fueling inflation. The Canadian dollar soared and bonds were hit hard. The loonie jumped to 1.2327 per US dollar, and that's up more than 0.5%, and it rose to as much as 1.2301 earlier in the day. The 2-year benchmark yield rose about 20 basis points to 1.063. We will be considering raising interest rates sooner than we'd previously thought, Macklem said at a press conference in Ottawa after the policy decision. Interest rates don't need to be as low for as long to get back to full recovery and to get inflation back. And Macklem maintained his pledge not to raise the benchmark overnight policy rate until the recovery is complete, but officials now believe that will happen in the middle quarters of 2022 rather than the second half of next year as previously thought. The language will reinforce market expectations the Bank of Canada is poised to quickly pivot to a tightening cycle amid growing price pressures, part of a change of course at central banks globally amid the stronger than expected inflation readings. Investors are anticipating the Canadian Central Bank will start raising interest rates as early as January, with markets pricing in 5 rate hikes next year. Shortages in manufacturing inputs, transportation bottlenecks, and difficulties in matching jobs to workers are limiting the economy's productive capacity, policymakers said at the statement. Although the impact and persistence of these supply factors are hard to quantify, the output gap is likely to be narrower than the bank had forecast. Stronger and more persistent inflation pressures drove hawkish adjustments to the Bank of Canada's policy statement, opening the door to a hike in the second quarter of 2022 if conditions warrant. But still, economists think it's difficult to square that with the downward adjustments the bank made to its GDP forecast through 2023. And the Bank of Canada also released details of how it will implement the investment phase of bond purchases in a market notice. It said it expects to be able to maintain its total stock of Government of Canada bonds by purchasing assets of between 4 billion and 5 billion Canadian dollars per month from both the primary and secondary markets. That'll take effect from 1 November. And Macklem has been using 2 major tools to keep borrowing costs low, maintaining the policy bank's rate near zero and buying up government bonds to keep longer-term borrowing costs in check. The benchmark interest rate was left unchanged at 0.25% on Wednesday, and the central bank has increased its bond holdings by about 350 billion Canadian dollars since the start of the pandemic. The more hawkish tone comes even amid a less rosy outlook for the economy because officials cut growth estimates for both 2021 and 2022, but argued much of that reflects the worse than expected supply disruptions in the global economy. Because of these disruptions, the Bank of Canada marked down estimates of supply by more than the downward revision in output. That means it now has less excess capacity in the economy and sees less reason to accommodate demand with cheap borrowing costs. The build-up of inflationary pressures also appears to be testing the Bank of Canada's patience. It revised higher its forecast for consumer price gains to 3.4% in both 2021 and 2022, And at the press conference, Macklem sought to reassure Canadians the central bank remains focused on bringing inflation back to its 2% target. We know higher prices are challenging for Canadians, making it harder for them to cover their bills, Macklem said. It's our job to bring inflation back to target, and I can assure you that we will do that. And so now back to Australia. ANZ said Wednesday's higher than anticipated core consumer price index increase indicates that underlying inflation is more widespread than thought and adds pressure on the RBA to hasten its monetary tightening. While some of these price pressures will likely ease through 2022, others will emerge as wages growth accelerates. This suggests the RBA may have less time on the policy front than it believes, they said. A sustained price in consumer prices will compel the central bank to bring forward its rate guidance 1 year to 2023 and drop the yield curve control program that has anchored yields and the 3-year bonds maturing in April 2024 to 10 basis points. If the RBA guidance about the move in the cash rate is brought into 2023, we think it likely the 10 basis point yield target will be dropped. So next week's RBA statement just got a lot more interesting, they said. And over at CBA, they said high vaccination rates and an earlier reopening of New South Wales and Victoria has led Commonwealth Bank to upgrade its forecasts for the Australian economy and bring forward its rate hike expectations. The bank noted the exceptional take-up of the COVID-19 vaccine, that the labour market held up better than feared during lockdowns in Victoria and New South Wales, and the reopening of the two states occurred ahead of schedule. Commonwealth Bank revised its 2021 GDP forecast from 3% to 3.5% and from 4% to 4.4% in 2022. It also expects unemployment to sit at 4.7% by the end of this year, down from its previous projection of 5.2%. And the bank's underlying inflation expectations were revised up from 2.1% to 2.5% in the middle of next year, and will therefore be within the RBA's target range of 2 to 3%. And it also expects the Reserve Bank to exit its yield curve controls in the second quarter of 2022, with the announcement to be made at the May 22 policy meeting. These factors will see the RBA deliver its first rate hike in November 2022, according to the bank. Its previous forecast was for May 2023. Commonwealth Bank Head of Australian Economics, Gareth Aird, cautioned in the note that there is a risk the RBA exits earlier, and the November board meeting next week is live regarding a decision on the yield curve target. And now it's worth noting that the number of capital city residents moving to regional areas rose 2% during the September quarter and 3% from a year earlier. This is according to an index published by RBA and the Regional Australia Institute. The index is powered by CBA data from relocations among its 10 million customers. The big coastal centres close to capital cities continue to attract the largest numbers of metro movers. Queensland's Gold Coast was again the most popular destination, followed by the Sunshine Coast, Greater Geelong in Victoria, and then Wollongong and Lake Macquarie in New South Wales. Despite lockdowns and travel restrictions in the major capitals, overall population flows from capital cities to regional areas continue to increase in the September 21 quarter. People moving from capital cities to regional areas accounted for 6.2% of all movers, a share that is unchanged compared with a year earlier. Population flows in the reverse direction accounted for a slightly larger share of overall movements, up by just 0.3 percentage points over the same period. COVID-era migration patterns continue to show a preference for regional areas. Capital city dwellers are moving to the regions in greater numbers, while regional people are electing to stay in place in greater numbers. Over the past year, those moving from the capitals to the regions have consistently accounted for a 6.2% share of total movements. Those moving in the other direction have generally accounted for a smaller share, around 4%. Over the past 6 months, however, this share has shrunk from 4.2% to 3.9%, reflecting fewer people moving from regions to capitals. This has become key to driving net migration higher over the latest quarter, with the index rising by 14%. Net migration is not far off the peak reached 12 months earlier, down by just 8%. Smaller LGAs, where absolute migration inflows tend to be smaller in number, and therefore subject to greater volatility, tend to dominate the list, making the list itself prone to significant changes each update. Against the backdrop of another Melbourne lockdown, Victorian LGAs are conspicuously absent in this update. The South Australian LGA Wattle Range, which neighbours Mount Gambier, saw the strongest growth in migration from capitals among all LGAs during the 12 months to September 2021. Douglas in Queensland experienced the second largest increase, and that was followed by Port Augusta in South Australia, Moree Plains in New South Wales, and Western Downs in Queensland. And over the September 21 quarter, however, the number of capital city people moving into Wattle Range and Western Downs declined by 33% and 11% respectively. The Douglas, Port Augusta and Moree Plains LGAs each experienced growth, up by 12%, 50% and 87% respectively. The largest numbers of capital city dwellers moving to regional Australia continue to head for the high population coastal centres close to the capital cities. The Gold Coast continues to be the most popular destination. The next most popular destinations are Sunshine Coast, Greater Geelong, Wollongong and Lake Macquarie. Of these top 5 LGAs, the Sunshine Coast recorded the strongest annual growth in migration from capital cities, up 16%, while Lake Macquarie recorded the highest quarterly growth, up 17%. The regional area net inflows chart shows the breakdown of net migration by state. It shows the share of net migration out of capital cities and share of net migration into regional areas. In the 12 months of September 21, the bulk of net outflows from all capital cities came from Sydney and Melbourne. Net outflows from those cities accounted for 47% and 48% of all net outflows, respectively, 95% of all net outflows combined. Regional Queensland is a key destination, in addition to regional New South Wales and regional Victoria, for net inflows with regional areas. And regional Queensland picked up 26% of net regional inflows in the 12 months to September 21. That distribution is similar to the previous 12-month period. Sydney Siders accounted for 49% and Melburnians accounted for 43% of net outflows. And regional New South Wales and regional Victoria picked up 35% of total net migration into regional Australia, followed by regional Queensland at 22%. So this trend is continuing, but I would say that the latest data from my surveys indicates that there is now a slower move to the regions. And in fact, some of those who move to the regions are beginning to consider a reverse move. So we may well see some significant changes ahead. And coming back to this question of that balloon, I would argue there are two balloons, the migration balloon and also the interest rate balloon, both held underwater, both under pressure, and both potentially subject to significant release ahead. We'll watch the data and see what happens. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.